Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly housing market update for you. This will be mainly information about the Phoenix metropolitan area, although we do talk a little bit about information that is nationally. And we are heading into the Labor Day weekend. And again, I want to keep in mind that usually for us, August, right straight through Labor Day is pretty slow typically in the Phoenix area. People are on vacations, even in August and the beginning of September with Labor Day weekend, of course. And a lot of people who want to go on vacation with or without their kids, even because school usually starts in August. People who maybe are management, mid-level management, a lot of times will go on vacation during these months. Super hot time of year. People usually aren't looking at homes; they're usually thinking about vacations. Our biggest time for people to buy and sell homes typically is going to be more towards the beginning of that cycle, after the holidays, during tax season, or going into the school ending. For us, school ends in March. So typically people want to be under contract just before that or right when that happens. And then they want to close out as quickly as they can so they can get on to moving into their property and getting on with their vacations for the summer. So that's kind of the seasonal thing about that. Keep in mind, seasonal is different for your area, and real estate is very regional. So I did just do a second part to Are We in a Housing Crash? I did part one last week. I just did another one. I'll be getting that up on pushing that out on all the social media. Make sure you like, subscribe, and share our information, and follow us on YouTube, Facebook, Instagram, and Rumble. And we'll be getting that out there. So, anyways, guys, here we go. Right now, I'm just going to run through some quick stats and then get into the details. Residential sales. Let's see, we are, and I went over this a little bit before, but our median days on market at the end of July, we're going to have the end of August numbers here shortly for you. But the end of July the median was 30 days on market. Our average closed days on market was 41. We're at 3.53 months supply, which is down just a little bit from where we were in the last couple of weeks. We were kind of closer to 4, but that's still a more of a balanced market. Usually for us, a truly balanced market would be about 4 to 6 months supply. And you'll see that line up with the numbers. So what we are again is more in a balanced market. In some areas, like the luxury markets, we'll see are a little different than some of the other areas. Our absorption rate is 28.30%. Again, pretty balanced and normal. We're kind of away from that crazy hysteria, insanity, seller's market that we were in. Our average list price right now is $685, and our average sales price is $554.9. And the list to sales price ratio is 97.39. 97.39. Usually we like to see that in the best case right around 98.2%. That means people are getting pretty close to their asking price, and there is some room in there, wiggle room for our buyers a little bit too. Just kind of put the sellers just right above that 98 mark at that point. So that's kind of a real healthy market for us in the Phoenix area. And I think in general, people would say around the country that works. So right now, the majority of our market, which is driving the average sales prices that we're looking at over 52%, is under $500,000 as far as our supply is concerned. 36.7% of our supply is just over 500,000 on up to just under 9,999, just under $1 million, 36.7%. And over $1 million is 10.7%. The lower section of days on market would be average days on market would be 50 days, and then the mid range was 56, and 90 days for a million plus, which is still really good. I mean, usually the over a million, is usually going to be about 110, 120 days. So still a pretty brisk market when you look at what is historically normal. Again, just think that we're in a normal market now rather than a crazy insanity market. So as far as the nation is concerned and what the feds are doing, which is always interesting, Jerome Powell says the Fed is ready to bring some pain to households and businesses. There are the unfortunate cost of reducing inflation. So again, I went over this in a little bit more detail in my first part of Are We in a Housing Crash? But the Fed is raising the interest rates, and that means the interest rates for basically what it means is it's gonna cost you more money, cost you more to borrow money. What that means, in lines of credit, credit cards, pretty much across the board, to borrow money is going to cost more, since it's costing the banks a little bit more to do what they need to do in order to get that money to you. That's in a nutshell at the street level, kind of a general idea. So it doesn't directly mean that interest rates for mortgages will go up, but indirectly it could mean that it will have an effect on mortgage rates, just so we kind of clarify the federal funds rate, okay, and what he's talking about. And they raise the rate when there is high inflation like we have now, and they raise the rate to combat that in order to settle things down a little bit more. And he says basically, those signs currently point to a possibility that high prices might be moderating. The bank isn't about to loosen up its policy tightening, according to Chair Jerome Powell. In fact, it's likely to keep hiking interest rates throughout this year until it's certain that inflation is in the rearview mirror. Okay, so no surprise there. We pretty much knew that was coming. They'll be making a determination on that this month sometime. I'm sure we'll know that about the next couple of weeks here and figure out where things are going to be on that front. So as far as what we talk about every week, and that is the Crawford Market Index. The Crawford report are a group of people who, for the last few decades, have been putting together some amazing information based off of our multiple listing service in our area, where all homes are listed and sold and tracked and all that. And in that will give us an idea what's going on with supply and demand and sales and listings and all that sort of thing, and prices. So the overall index right now puts us at 106.5. What that means is, in the Crawford Market Index, if you're between 90 and 110, you're in a balanced market between 90 and 110. We're at 106, so we're right in that range of 90 to 110. If you're under 90 on the index, you are in a buyer's market. And if you're over 110 on the overall index, you're in a seller's market. So right now we're at 106.5. We're right there, pretty much right in the middle in a balanced market. And as far as our demand is concerned and supply, when those two numbers are the same, doesn't matter what those numbers are, but when they are equal to each other, that means we're in a balanced market. Well, guess what? Our demand is at 79.2. So that means it's, under that 90 mark, right? 79.2 as far as the balance range. Okay. So our demand is lower than would be typically, it's if you're looking at the 100 mark, it's about 20 points lower. And if you're looking at the supply, using round numbers, if you're looking at the supply, we are at 74.4. Okay. So our supply is, even though it seems like we did get a triple or more than triple the inventory we had at the height of the crazy insanity market. I mean, there were some weeks where we're at 4,000 or 5,000 total active properties at any given time when we go on the MLS. Right now we're 74.4. That, of course, is below the 90 to 110 mark of the balanced market as far as the overall is concerned on the index. But it doesn't matter what those numbers are on the supply and demand. So in other words, supply overall is is down. It's down at the lowest end of the spectrum. It's down 16 points or 15.6 points, and to get to 90. But supply is 74.4 and demand is 79.2. That means those two indicators of supply and demand are only about 5 points apart. Okay. So they're pretty close to being the equal or same number, which means we're in a balanced market, which is what the overall index tells us at 106.5. So now that we understand that a little bit more, let's first look at, before we look at the more of the cities and what's going on there, listing success rate. Back around March, our listing success rate March of this year was 92.2. And in order for us to kind of equal that, we'd have to go all the way back to looking at some of the numbers that we saw back in 2010. The lowest numbers that we'd have to go back to look at is 2010 compared to where we are right now, because right now we are at 70.4%, and in 2010 we're at 58.1%. So that still means, again, it's kind of a normal market. That means 30% are not successful listings, meaning that 30% will go expired or not sell, or at least not sell on the multiple listing service where most homes are listed and sold for sale. So that kind of gives us an indicator again that we're in a balanced market. It's kind of what a normal market would look like, pretty much. Because in a normal market, not everything's going to sell. Maybe it's priced too high. Maybe it's in an area that isn't what people are looking for. It's not in trend. It's not updated. It's not a high demand area. Whatever the case may be. That's kind of where we're at. But new listings, here's an important thing on what's going on right now. New listings by month. And I went into this a little bit last week, and that is that in July, we ended up with over 10,000, almost 11,000 homes that were listed for sale. In June, we had 12,400. In May, we had 11,612. April, we had 10,565. March, we had 10,004. And February and January, we were over 8,000, almost 9,000 homes for sale each of those months. But those are usually lower listing months anyway in a seasonal cycle. So that's no surprise there. But when we're looking at this now, we're seeing that, we're at 79 for August right now, up to date. We're at 79.01. We're not going to be anywhere near, and I pulled these numbers on the 29th. We're not going to be anywhere near, excuse me. We're not going to be anywhere near any of those other numbers that we've been seeing the last 2 or 3, 4 months. So guys, that could indicate a slight shift, which I'll get into in more detail here. But active listings, again, that'll affect our supply, right? So if it affects our supply, and we happen to know that usually seasonally, right after Labor Day through October, maybe beginning of November, we do have a lot of properties go under contract right before the end of the year, right before the holidays. So we'll see how that goes. Active listings, right now, excluding what's under contract or contingently under contract for sale, active listings are at over 19,000 right now, and I just double checked it. It's still the same. Some days this week it was kind of hovering around 18,000 something, but it's 19, a little over 19 is about normal, and that's what it was just when I last checked it again. The active listings for These areas are actually cities decline as far as active listings right now. It could be in a seller's market, possibly. No promises made, but could be in a little bit of a market shift. Okay, is Chandler, Gilbert, Glendale. Again, this is in the Phoenix metropolitan area. Phoenix, Chandler, Gilbert, Glendale. I'm sorry, start over again. Chandler, Gilbert, Glendale, Mesa, Peoria, Scottsdale, and Tolleson. They've seen drops in their inventory. Again, we'll see if this is just a seasonal thing because we're in August. It's usually, July, August, right till we get through Labor Day, kind of slower months for us, especially August and beginning of September with Labor Day. So we'll see how this continues on, but numbers could be, shifting here. So we'll keep an eye on that. Numbers are, let's see, we'll see that numbers are, a little bit inflated too when it comes to some of this stuff, because a lot of the home builders are starting to put their properties on the MLS. They have now for the last 2 or 3 months. Why? Ever since like April, May, because the inventory and changed with the resale homes, and there was a little bit more of those available, and then they were having to start putting their homes on the MLS, which sometimes they do, but they're doing it even more than they normally do because they built a lot of spec homes to try and keep up with the demand that we had up until the spring and early first quarter of this year and last year, when the crazy insanity market was happening. So keep in mind that the active and under contract, a lot of those are newer homes. So we're seeing that active listings, weekly counts compared year by year, our active listings are up quite a bit, 162% in active listings. But listings under contract have actually are actually down about 28%, but now we're seeing that they're actually starting to creep up. We're actually starting to see where they're creeping up in the greater Phoenix area for properties that are going under contract. So we'll see if that trend comes. So that means our demand, when we start seeing these numbers shift, and we're going into the next month or two where we usually have a normal surge, we'll see how that goes. We'll keep an eye on that. Okay, so we could start seeing a shifting, at least in some cities and areas. Listings under contract, again, compare weekly, are definitely up, quite a bit when we're looking at the overall numbers, and where they were just a week ago. In the last couple of weeks, they've started a little bit of a surge, going from about 73 to 7,900. So we'll see if that continues. The prime mortgage right now is hovering right around 5.2 for 30-year, 4.9 for 15-year, and for 5-year ARM 4.3. I'm sorry, 4.4. Those are the overall averages. Probably get better rates with a mortgage broker, which we could certainly refer to you. But the important thing is the monthly average sales price per square foot. We did see the overall sales price drop a little bit, starting in around June, May to June. We saw a drop of about 4%, 4.4% in the overall sales price, because again, we weren't getting the crazy high end of the comps or way over the high end of the comps and creating new comps. Crazy insanity market we saw over the last year. We saw more normal average price sales going on. But now with that 4% drop since May, we actually saw in the last month price per square foot go up 1.4% increase in the last month. So we'll see how that goes, and keep an eye on that. Again, we're heading into season again, where we're going to probably see right after Labor Day a little surge right before the holidays, and then everything kind of calms down. There are buyers out there during the holidays. They're usually very serious buyers. Okay, so that's one good thing, but there's usually less inventory during the holidays too. But once we get through Labor Day, get about a week maybe into that, into September and October, usually a lot of properties do go under contract. Not as much as, in the super speedy time of, March, April, May for us here in the Phoenix area, but a good number higher than some of these other months that we're getting through right now. So we'll keep an eye on that, see how that goes. The top sellers market right now are going to be in the luxury areas of town, so to speak. That's going to be Fountain Hills, Paradise Valley, Scottsdale, Cave Creek, and Goodyear is right up there in a seller's market, but it's a little bit on the lower end at 112. It's kind of bordering on being in a balanced market. Those properties that are so we'll kind of see where Goodyear goes. Balanced market cities are going to be Avondale, Phoenix proper, Mesa, Glendale, Peoria, and Chandler. And buyers market cities are going to be on a Crawford market index, meaning if you're in a buyer's market, you're below 90, right? Seller's market's over 110, balances between 90 and 110 on the overall index. So that's where these cities are. And so the cities that are in a buyer's market are going to be Surprise, Tempe, Gilbert, Maricopa, Queen Creek, and Buckeye. So we'll keep an eye on that and see where that goes. And I mentioned this in my part 1. I did a part 2, which will be up soon on all social media, being pushed out, going out in our weekly email. But I mentioned this in my part 1 of my Is the Housing Market Crash? I just did a part 2, which we'll be pushing out. But this idea that is the housing market going to crash? Everybody on the media is saying it's going to crash. Well, how do they make their money in the media these days? Well, big way they make their money in the media, besides all the commercials and ads you see from certain companies out there, is through clickbait. They make their money through clickbait online because most people get a lot of their information online these days. So and a lot of people don't even read into stories. They just look at maybe headlines a lot of times and just think, oh, right. So sometimes it's funny, you'll see a heading, but then when you read into it, it doesn't really say what the heading says. But anyway, that's a whole nother story. But just to kind of throw these out there, and again, these are in my part 1 of Is the Housing Market going to Crash, which I get into more detail on this and other stuff. But just real quick, let me run through these. October 15th, housing today, bubble larger than 2006. And at that time, overall home price on average was going to be 300,000. Okay, it was 300,000. Again, this is nationally. And that year of 2015, it was 5.1% appreciation. So if you listen to the media, you would have lost out on at that price, $15,000. August of 2016, we're in a housing bubble. Oh, that year it went up 5.4% at $17,000. That would put you at 332,000. November 2017, homeownership doesn't build wealth, study finds. That year it went up 6.1%. That would put you at $20,000 increase at 353,000. September 2018, it's better to rent than to buy in today's housing market. Okay, which is typically a lot of times usually never the case. If you can afford to buy a house, you got to quantify that. If you can afford to buy a house, you're going to be there at least 4, 5, 6 years. Which the average I think is running right around 7 years right now. You're going to be better buying because you set your payment, right? You set your rent. Your rent's not going to go up, okay, on a fixed rate. Rent's not going to go up. Your mortgage rate's going to stay the same. You're gaining equity every year, okay, historically in the Phoenix area. Again, at least 4.5, probably around 5 to 6% typically. We saw the last couple of years have been the housing lottery, of course. and you get tax benefits, and you have the freedom of, your family being able to do what they want to do in the house. So in 2018, it said better to rent than to buy in today's housing market. That year it went up 4.1% nationally. That's $14,000. That's $367,000. And the house you bought just a couple of years earlier at 300,000, it's worth 367. In 2019, the housing market is about to shift in bad way for buyers. It went up 4% in 2019, July of 2019. This is the stat, and then it went up $15,000, $382,000 is where you're at this point. December 2019, next year will be hard on the housing market, especially in these big cities. Well, by the end of that year, by the end in December, when this was said, it went up 16%. That's $61,000. That's $443,000. Okay. And then overall in 2021, it went up 18%. That's $80,000 at that point, and it puts you at 523,000. So if you listen to the mainstream media just throughout those 7 years, you would have lost, or 6-7 years, into not even getting into this year, you would have lost from a $300,000 average home in America. You would have lost $223,000. This is why it's important to make sure you really dig into the information, talk to a professional or two that knows what they're doing, that's been in the business a while, that you trust. And a lot of people say, well, yeah, Chris, but you just want us to buy so you can make money. Well, guess what? Helping you buy a home I don't charge you a dime. Okay. And the more money you make from the sale of your home, okay, and the happier you are when you buy your home and when you sell your home with me, the more recommendations I'm probably going to get. The more money you make on the sale, you make more money. Okay. I'll make more money. So I want you to do the best you can do, right? Right. So this whole thing about, what the real estate agents do and don't do. And there's a lot of dummies out there, don't get me wrong, but it's important to make sure you have a good agent that knows what they're doing, that's going to have your best interest in mind. So with that said, we can see where the mainstream media is coming from with historical value right there. So let's talk when you're ready. Okay. The average monthly, this is coming from the Crawford Market Index people, Crawford report, and talking about the different cities and stuff that I had mentioned earlier. And they say this, I'm just going to read the whole thing to you. The average monthly change in CMI, that's the Crawford Market Index, the overall index that I gave you earlier, was the average change in the monthly CMI was minus 20%. This is another improvement on the week before when the reading was negative 25%. In other words, it's dropping in the overall index, which means we're getting in more of a balanced market, right? Or in some areas, buyer's market, still some areas, seller's market, just not as much of an insanity market, but it's dropping at a slower rate now by quite a bit. Although we're still seeing a deterioration for sellers over the last month, most of that happened in the first 2 weeks. That is late July and early August. The deterioration was slowly, markedly during the middle of August, and CMI ratings are falling much less quickly now. The decline over the last week was only 2.5%. A few cities are even seeing their CMI rising in the last few days, including Paradise Valley, Chandler, and Tempe. This is the first significant silver lining to dark clouds that have hung over the market since April. Okay, that's when we had the lower demand, surge in supply, lower overall demand. Demand is still good, but lower overall demand. And rates certainly had something to do with that, but so did all the clickbait, right? So demand has picked up in some areas in the shape of increase in numbers listing going under contract. This is most noticeable in Chandler, Mesa, Phoenix, Tempe, and Paradise Valley, but also occurred to smaller extent in Glendale, Gilbert, and Surprise. So properties going under contract is a good thing. That's going up. That's a good thing. In addition to improving demand, new supply has weakened to below normal. Only a few weeks ago, new listings were arriving at a very fast pace, but this seems to have subsided now. Some areas remain heavily balanced in the buyer's favor, but overall, the market looks ready to settle into a more stable situation if current trends persist. Okay, so more of a stable, more balanced type market overall. Paradise Valley has overtaken Fountain Hills to make number one to make number one on our table. Okay, on the overall index and table of cities. The top 4 slots are occupied by the 4 most expensive of the 17 cities. Okay. And I've mentioned this many times too, but our economy here, our jobs market and all that's very strong in the Phoenix metropolitan area. So guys, that's all I got for you today. If you have any questions at all, want to reach out to kind of go over this. We'll kind of keep an eye on things, see where things go, and then keep you updated on all that, of course. But it's really interesting on what's happening in the market and how things can shift from week to week, month to month. But overall, we're just not seeing a crash. We're seeing a more of a stabilized normal market overall, more of a balanced or close to balance in most areas. In some areas, a little bit more of a seller's market, a little bit more of a buyer's market, but overall it's a pretty stable and brisk market and healthy market here in the Phoenix area right now. So guys, reach out always to us. If you can always call or text us at 480-788-8569 or email us at home@mincolagroup.com. That's home@mincolagroup.com. Check us out online at mincolahomes.com or mincolagroup.com. Guys, we'll see you next time. Always make sure to like, subscribe, follow us on YouTube, Instagram, Facebook, and even Rumble now. So we'll talk to you guys soon. Thanks.